The global economy remains on track for a gradual recovery from the pandemic and Russia's war on Ukraine. China's reopened economy is rebounding strongly. Supply chain disruptions are unwinding, while the dislocations to energy and food markets caused by the war are receding. The massive and synchronized tightening of monetary policy by most central banks is starting to bring inflation back towards its targets. At the same time, serious financial stability-related downside risks have emerged. In our latest forecast, global growth will bottom out at 2.8% this year, before rising modestly to 3% next year, almost unchanged from our January projections. Global inflation will ease, although more slowly than initially anticipated, from 8.7% last year to 7% this year and 4.9% next year. This year's slowdown is concentrated in advanced economies, where growth is expected to fall to 1.3% this year, before increasing modestly next year. By contrast, emerging market and developing economies are already pushing ahead in many cases, with year-end growth accelerating to 4.5% this year from 2.8% last year. The recent banking instability reminds us, however, that the situation remains fragile. Once again, downside risks dominate. First, inflation is much stickier than anticipated, even a few months ago. While global inflation has declined, this reflects mostly the sharp reversal in energy and food prices. But core inflation, excluding energy and food prices, has still not peaked in many countries. It is expected to decline to 6.2% this year, still well above target. Activity too shows signs of resilience. At this point in the tightening cycle, we would expect to see more signs of output and employment softening. Instead, both output and inflation estimates have been revised upwards for the last 2 quarters, suggesting stronger than expected global demand. This may call for monetary policy to tighten further or to stay tighter for longer than currently anticipated. There is little evidence of an uncontrolled wage price spiral. Nominal wage inflation continues to lag price inflation, implying a decline in real wages. But labor markets are still very tight in many countries. This suggests real wages should increase, and we expect they will. Corporate margins have surged in recent years. This is the flip side of steeply higher prices, but only modestly higher wages, and should be able to absorb much of the rising labor costs on average. As long as inflation expectations remain well anchored, as they are now, that process should not spin out of control. More worrisome are the side effects that the sharp policy tightening of the last 12 months is starting to have on the financial sector. We have repeatedly warned this would not be an easy ride. Following a prolonged period of muted inflation and low interest rates, the financial sector had become too complacent towards maturity and liquidity mismatches. Last year's rapid policy tightening triggered sizable losses on long-term fixed income assets and increased bank funding costs. The brief instability last fall in the United Kingdom's gilt market and the recent banking turbulence in the United States illustrate instead that significant vulnerabilities do exist both among banks and non-bank financial institutions. In both cases, financial and monetary authorities took quick and strong action and so far have prevented further instability. Broader markets have remained calm and volatility has been contained, including for emerging and developing economies. Increasing funding costs and the need to act more prudently, however, may push banks to cut down lending further. In our World Economic Outlook, we explore such a scenario and find that it would lead to an additional 0.3% reduction in output this year. Yet, the financial system may well be tested even more. Nervous investors often look for the next weakest link, as they did with Credit Suisse, a globally systemic but ailing European bank. Financial institutions with excess leverage, credit risk, or interest rate exposure, too much dependence on short-term funding, or located in jurisdictions with limited fiscal space could become the next target. So could countries with weaker perceived fundamentals. A sharp tightening of global financial conditions, which is sometimes called a risk-off event, would have a dramatic impact on credit conditions and public finances. especially in emerging market and developing economies. It would precipitate large capital outflows, a sudden increase in risk premia, a dollar appreciation in a rush towards safety, and major declines in global activity amid lower confidence. In such a severe downside scenario, global growth this year could fall to about 1%, an outcome whose probability we estimate at about 15%. We are therefore entering a tricky phase during which economic growth remains low by historical standards, financial risks have increased, yet inflation has not decisively turned the corner. Policymakers will need a steady hand and clear communication. First, with financial instability contained, monetary policy should remain focused on bringing inflation down, but stand ready to adjust promptly as financial developments might demand. A silver lining is that the contraction in bank lending could partially mitigate the need for further monetary policy tightening. But any expectation that central banks will prematurely surrender the inflation fight would have the opposite effect, lowering yields, supporting activity beyond what is warranted, and ultimately complicating the task of central banks. Fiscal policy can also play an active role. By cooling off economic activity, a tighter fiscal policy would support monetary objectives. Appropriately designed fiscal consolidations can help rebuild much-needed fiscal buffers and help strengthen financial stability, something that we explore in Chapter 3 of our World Economic Outlook. While fiscal policy is turning less expansionary in many countries this year, more could be done to regain fiscal space. Regulators and supervisors should strengthen oversight to ensure any remaining financial fragilities don't morph into a full-blown financial crisis. For emerging market and developing economies, this also means ensuring proper access to the global financial safety net, including the IMF's precautionary arrangements, access to central bank swap lines where relevant, and foreign exchange reserves. Exchange rates should be allowed to adjust as much as possible, unless doing so raises financial stability risks or threatens price stability, in line with our integrated policy framework. Our latest projections also indicate an overall slowdown in medium-term growth forecasts. 5-year ahead growth projections decline steadily from 4.9% in 2011 to 3% this year. Some of this decline is predictable. Growth slows as countries converge. But some of the more recent slowdown may also reflect more ominous forces: the scarring impact of the pandemic, a slower pace of structural reforms, as well as the rising and increasingly real threat of geo-economic fragmentation, leading to more trade tensions, less direct investment, and a slower pace of technology adoption and innovation across fragmented blocs. Fragmented world is unlikely to achieve progress for all or to successfully tackle global challenges such as climate change or pandemic preparedness. We must avoid that path at all costs. Thank you.